session for today, November 23, 2022. My name is Jose Blasco, as you can see right, above my head. My name is there, my email is there, our social media handles are there as well. So this, sorry for that, guys. I got the sound coming back to me. Okay, that's fixed now. Sorry about that. So I was saying that my contact information is available there. I assume that going through the contents today may generate a few questions that you may have. And again, I want to make myself available for you guys to contact me if you have any question that you would like to clarify. Happy to help. Very excited to be part of the session today. Like every time when we get together, and typically 1, 2, maybe 3 times a month, depending on the month. Always a pleasure to be part of the Tiger Broker community, which I want to thank you here as we begin. So as we are getting started and we are getting organized, I would like to share a few things before we start, which is number one, there is a financial disclaimer on the top part of the screen. Please read it carefully. It is important information. As we all know, trading carries with it financial risk. So it is critical. It is important that you understand that. And the disclaimer is there for that purpose. Second, know that I am watching you. That means that I have 2 windows open. In one, I am looking at the Tiger Brokers app. I'm watching at the chat box, and also I am looking at YouTube Live. I am also looking at the chat box because my intention today is that you not only enjoy the session, but actually you learn. And the best way to learn is to ask questions and to be engaged. So I would like to ask everybody not to be shy. We are here to learn. While I am an expert, there was a time in my life where I was not. And the way I learn is by asking questions. So please feel free to ask me questions. And no, as I said, I'm here to help. Okay, do not be shy. Okay, and the best way to prove that you are not shy is just to type hello in the chat box. Okay, so that would be a great way to get started. I guess it's fair for me to request that hello since I said hello myself. So now it's your opportunity and your time, your turn to say hello back to me. Okay. One last thing before we begin. The session is gonna have 2 parts. One is gonna be our SMARTT session, which is the special market analysis report for Tiger traders. And we call it SMARTT because we're going to be looking at options data to understand what is likely going to happen in the market. So instead of doing technical analysis by looking at the charts and looking at the trend, which of course, I'm not saying that's not important, but beyond looking at candlesticks or candles or charts, we're going to look at what are the options markets telling us, okay, using advanced technology, and we'll discuss that later. So pay attention, this is important stuff. And second, talking about options, as we always do during the Tiger Live sessions, we also have a little bit of an options lesson throughout the presentation to help you understand better your choices. I love to say options give you options. It's me playing with the words, but also it's so true. You can do so many things with options that you cannot do with other assets that, it's great to understand your choices. Today, we'll talk about coloring your stocks, okay? So again, feel free to ask questions. So far, you guys are proving to me to be shy. So please do not be shy, be engaged with me. Again, participate on the chat box so you can learn more and, again, seize the opportunity with me here. Agenda, so introductions, I'll very briefly mention who I am. Key headlines, we're going to talk about what's happening in the market from a headlines point of view, from a news point of view. No, I'm very pragmatic, so I'll keep it very short. Then from there, we're going to jump into the lesson for the day, which is coloring stocks. Then we'll talk about the market commentary, which is the SMARTT, okay? Market commentary, which has to do with options data instead of candlesticks. And then we'll look at a bonus for you. I have a little gift for you. If you have never been part of the sessions, and you will know what it is towards the end. And then Q&A, which for sure we can do Q&A at the end, but to be honest, my preference is that you guys present your questions as we go through the materials, so I can be more specific. The initial portion of the session will have me use a PowerPoint presentation by now. Know that later I'll get rid of them, and I will jump into real-time charts, and we will look at the markets real-time. Okay, so just know that I will get rid of the PowerPoint presentation the sooner I can, even though it will be handy to use a few slides to go over the lesson. And finally, here, a zero commissions card from Tiger Brokers for your options trading on US options. So just scan the code if you haven't done it yet. And, you know, again, just enjoy your free commission so you can practice your options trading at no cost, okay? Cool, wonderful. Thank you guys for your okays and your nice comments on the chat box. This is very appreciated. Thank you so much, guys. Cherry Pang, Tantiad, Meow, you know, JY, Eng Sim Seng, everybody, my friends, thank you so much. Again, I'm super excited to be here. So, quick introduction. Who I am. My name is Jose Blasco. What do? I am a trader. What do I trade? All assets. Why? Because everything in life got pros and cons. And while options are great, they have disadvantages. While futures are great, they have disadvantages. While stocks are great, they have disadvantages. And this happens to all assets. So what I like to do is, depending on what is it that I'm trying to do, maybe a short-term trade, maybe an intermediate-term trade, maybe a long-term trade, maybe directional, maybe non-directional. So depending on what is it that I'm trying to accomplish in the marketplace, I use different assets. Options is my favorite. I'm super passionate about it. Why? Because options give you options. You can do directional, non-directional, volatility plays, earnings plays. My God, so many things. So that's you know, something I do appreciate very much. Okay, and therefore is my little favorites. Okay, even though I do trade all markets. As you can see as well, I am an author of a book. The book is about forex trading. Even though, to be honest, this book applies to all trading, no matter the asset, because trading is trading. So the concepts that are taught in the book would certainly be useful when trading options. And also in the end, even when you trade options, in the end, your options are priced in dollars, which is a currency, meaning that understanding forex or the world of currencies is certainly useful. So if you'd like to take a look at the book, you can find it on almost every bookstore. $3.88 is the price of the book if you buy it as an ebook. If you buy it as a paperback format, is $18.88. So it's very affordable. It comes with a course, and on top of that, you also have 3 months of free access to our trading technology, which is built in the book. Okay, so again, it's a very nice way, 3 months for practice. And again, I'm very passionate about what I do. Okay, so tradewithufos.com is our website, is the company that I represent, which is my company. What are those UFOs? Well, if you have not attended a session with me before, UFO stands for on-field orders. They look like flying saucers on the chart. You will see that real time later. And they can be applied to all markets, all time frames, all trading styles, including options. And they can be used by themselves, or they can be used as a complement or a confirmation of other trading methodologies. Example, maybe you're a Fibonacci trader, but you're undecided today. You know, should you trade the 61.8? Should you trade the 50%? Should you trade the 38.2? Maybe you're a moving average trader. You know, should you trade the 20 moving average? Should you trade the 50 moving average? Which one should you trade? Well, you turn on the UFOs, and the UFOs will tell you. Okay, so it could be used as a trading technique by itself, or it could be combined. Okay, with all of this said, let's begin. So headlines. There are a few things on this slide that you have seen before, because to be honest, certain very relevant situations in the marketplace are long-lasting, and therefore, for example, Russia-Ukraine, that's nothing new. And in recent times, if you wish, it's something that, you know, like it happens sometimes, even though it's totally unfair. But, you know, people tend to forget, right? And then it's kind of like the world lives their life like nothing's happening, while there is a real conflict and people dying in the real world in Ukraine. So again, that's what's happening. Okay, so why is this in the headlines where I just said that people tend to forget? Well, because it's happening. And the thing about conflicts such as the conflict with Russia, Ukraine, there are many other wars in the world as we speak as well. But obviously this one is very relevant because being in Europe has a direct impact. You know, if NATO gets involved, then the US is involved. So again, if something was to happen, okay, and I don't want to mention anything specific because I don't want to trigger the law of attraction, okay, for bad things. But if something was to happen, next thing you know, overnight, we may see the markets, the S&P and other key markets, we may see them gap down 10%, you know, things like that. So again, we gotta be careful. Okay, things are happening in the world, and it's not a joke. Okay, what else? U.S. fighting inflation. Okay, that's nothing new. The Fed has been raising interest rates for multiple months in a row, multiple quarters in a row, and that has had a great impact on the US dollar, and therefore many markets have moved. So it seems that now the expectation is very clearly set, where they will keep raising interest rates, and now it's not going to surprise anyone, and everybody's expecting it. So now that my expectation is that next year, no surprise, surprise, there may be a month where they don't rise interest rates, and that may create a peak of volatility in the marketplace. Okay, so this is to be watched. You know that the Fed announcements tends to take place on the Wednesdays, once per month on Wednesday. So make sure you watch your economic calendars, and those Wednesdays, be careful with positions and things of that sort. USD movements are pushing markets in multiple directions. So there's been a moment in time in the past few months where the US dollar has been moving up nonstop. Next thing you know, we saw red UFOs coming in the US dollar, and the US dollar has been going down, hit the green UFOs, and go back up. So the US dollar has now been moving up and down instead of straight up. It's been moving up and down. So what happened? Many markets have been moving up and down, and that affects stocks, but also commodities. Could be gold, could be crude oil. Plenty of movements, okay, which is a lot of volatility. But then, funnily enough, contradiction. This week is Thanksgiving, and you can see that in the past 2 or 3 days, the S&P has been quite quiet. Okay, so I've personally been doing a lot of non-directional trading because the markets have not been moving too much in the past few days. So expect that probably until the end of the week, unless something happens, and expect volatility to resume after Thanksgiving. Thanksgiving is on the Friday, so next Monday probably we'll have a little bit. We'll have a little bit of action again. Okay, so watch that. It's out there. Keep all of this in mind. And finally, earnings reports today. We got 61 earnings reports being presented out there. Not too many are relevant, and of course the 2 I picked, which are the most relevant ones, are, I'll start from the bottom, DE, Deere and Company, which obviously it's a fairly relevant company in the US market, but also, of course, it impacts us directly here, isn't it? Tiger, okay, UP Fintech Holding Limited, which is the mother company that owns Tiger Brokers as a company. So really that has a direct impact to all of us. It's also reporting earnings today before the market opens. Okay, so you can go take a look before the market opens and see that. Okay, you may actually own some of those shares, which, by the way, have been doing amazing in the past few months, isn't it? Great, so those are the news. Okay, so now let's jump into the lesson for today, and then we'll move into the real-time charts. I welcome your comments. Okay, I just made a few statements about what I see in the marketplace and so on. If you have questions about that, if you disagree and you would like to present your point of view, for sure, do that. Use the chat box. And if all is good, I would love it if you guys could say or could type all good. I would certainly appreciate that. So that way I don't feel I'm talking to my screen. I feel that you guys are there listening, you're paying attention. Again, all of this is important, relevant stuff. I am very pragmatic, so it's not like I invented the wheel or anything here, but I did make a few statements that are relevant, such as, the fact that there is little volatility to be expected this week, but a peak of volatility probably coming in next week. So again, those things are for you to take into consideration as you manage your portfolios, as you are trailing your stops, or everything else, right? So important stuff. I would love to know that you are with me, so please type all good if all is good. And if you have comments, please type them in. The lesson for today: how to benefit from coloring a stock by combining call and put options together. Okay, so what's a color? Why would you do that? How to do it? How to combine those calls and puts? We're going to talk about all of this. And for us to understand this concept more easily, first, I'm going to talk about it from a theoretical point of view and show you one example on the slide, and then move in the real-time markets and show you a real-time example of a color, so you will get it 100% after that. So first, let's think about it from a concept point of view. And before I talk about colors, I want to talk about cover calls, okay? Which is a strategy which is known by many stock traders and investors, okay? Stock traders and investors that own shares of stock, they are in most of the cases, maybe it's new to you, and if that's the case, listen carefully, but most of the traders are familiar with cover calls. And that strategy is very simple. You basically sell out of the money calls. Out of the money calls are calls above the current price. So if you are trading a stock which is currently trading at 100, so you may sell the 110 call. So if the stock goes up to 110, then you will need to deliver the stock at 110. Okay, so you acquire the obligation to sell the stock at that higher price, 110 in my example, and in exchange for you to acquire that obligation when you sell the out of the money call, you get premium. When you sell something, you get paid. You sell a call, you get paid premium. So now you got premium, and if the stock goes up, you sell it at 110, which is going to give you a profit. But on top of that, you collect and keep the premium, which is going to be adding more to that profit. And the other side of that is that the premium received is often seen as a minor defense in case the stock moves down, as the premium received acts as a small buffer that would absorb some of the losses produced in case the stock went down. So, example, you own a stock which is currently trading at 100, you sold the 110 call, and you got paid $1. So because you got paid $1, if the stock goes up to 110, you sell it at 110, but because you got paid $1, you keep one on top of 110. So it's like you sold it at 111. Okay, so sold it at 111. Okay, so it's you sold it at 110, but the net effect in your account is like you sold it at 111 because you got paid $1. Now, the opposite is true if the stock goes down. If the stock goes down, you lose money. But whatever you lose is diminished by one. Why? Because you got paid $1. So that $1 is a small, it's a minor defense in case the stock moves down. You could afford the stock to move against you by $1, and it's still okay. If it moves beyond $1, then you are losing. So in other words, selling a call is not a little defense, but if the stock goes up, you make a very commonly used among. Now, for traders that have the opposite belief, traders that are concerned, the stock at 100, Ukraine and Russia, let's say something crazy, real crazy happened there, and the stock opens gapping down 20% down, well, then your $100 stock now just became $80 because it dropped by 20%. So 100 minus 20% is 80. So of course you would be in pain, right? But what if before that happens, you buy the 95 put? Well, if you buy the 95 put and the stock drops 20%, you have the right to sell the stock at 95 no matter what. Even if the stock went bankrupt all the way to zero, you can still get rid of that trade at 95. So of course 95 is below 100, so you will lose a little bit, but you have a way to defend yourself with a guarantee. Your guarantee in this example is 95. That's why premium needs to be paid. It's like you buy insurance. It's like buying a put is like buying an insurance policy. The stock drop, you are guaranteed to have that fixed exit price. Now, what's the issue? Well, the issue is that you often end up paying crazy amount of money for the put. Okay, especially when traders get concerned about a stock, not behaving. Typically, it's because the stock started dropping already, and when you start buying puts as the stock is going down, implied volatility increases. I mean, the whole thing is against you now. And now the amount of money to be paid, the premium to be paid is exorbitant. And while you have a guaranteed exit price, it's very inefficient because now you may have a guaranteed exit price to exit at 95, but you may have to pay $10 for that. So you are out at 95, but you lost $10 to have the right to do that. So your exit price is equivalent to 85, still better than 80, right? But it's terrible because you want it to be out at 95, and 95, if you pay 10 for that, so that's 85 is your exit price, right? So it's an exorbitant amount of money to be paid in most of the cases. So while many people know that buying a put gives you protection, it's not efficient in most cases. While many people know that selling a call, it's a nice way to get some premium coming in, if the stock goes against you, it doesn't give you proper protection either. So what can we do? And this is where the collar strategy comes into place. What can we do? Well, we can do both. Take a look. When collaring a stock, the owner of the stock would sell a call, an out of the money call, which is the same call you would sell in a cover call application. But now instead of thinking of the premium as something you keep, now the idea would be to use the call premium received to buy a put which cost that amount, right? So the goal is to go as close to free as possible. So if you sell a call and you get paid 1, the idea is to try to find a put that costs you 1. So you get paid 1 by selling the call, and you use that $1 to buy a protective put. That way, you are now in a position where the worst case scenario, it's totally predefined, but it didn't cost you anything because the call sold pays for the put bought. Okay, the call sold pays for the put bought. Okay, so the end result would be exactly as owning a bull call spread. Okay, and here I may be driving you crazy. I will show you that in a moment. But basically, when you do a collar to your stock, you are now enjoying limited reward, but also limited risk. So limited reward is what you get when you do a cover call. Okay, in my prior example, I was using 110. So let's say you own a stock trading at 100, and the stock went up all the way to 200, double the price. But you had sold a 110 call. You are obliged to sell at 110. So the most you will make is 110. So even though the stock went to 200, the most you will make is whatever it is until 110. So it's limited reward. Okay, now, limited risk is also cool. Why? Because if the stock drops all the way to 0, because you own a put, remember, doing a collar is sell a call and buy a put. So because you own the put, that stock is protected. So the most you can lose is limited, so it's limited risk, okay? Unlimited reward. So that's like a bull call spread. Okay, so if you know bull call spreads, when you buy a call and you sell a call together without the stock, okay, that's exactly the same as doing a collar. But that is without the stock. So if you own the stock and you want the stock to behave like a bull call spread, so then you would collar it, okay, which is very, very intelligent. If you want to own stock. Why would you want to own stock? Well, maybe the stock pays dividends, so you don't want to release the stock, and you keep the stock while you collect the dividends. But in the meantime, you have that stock protected for free. Okay, so that's the idea. So let's take a look at this application, and then we'll move into real time. So in this application, we have 2 examples. Okay, the example on the top. Okay, if you look carefully, and you may need to zoom in on your screen, I cannot, unfortunately. On the top, it says, you buy 100 shares of stock, and you sell the 280 call, and you buy the 270 put. If you look carefully, okay, the 280 call pays you $5.28. Again, it's probably very small print. I'll do a real-time example in a moment. I will zoom in, no worries. So that call pays you $5 plus. And the put purchase pays you $6 plus. So basically, it's not free, but it's as close to free as it gets. Okay, it's $1. So with $1, you get the color. And then the risk profile is what you can see with the blue line. So if the stock goes down, it's flat. The most you can lose is $457. If the stock goes up, the blue line is flat. The most you can make is $543. Okay, and to compare that with the bull call spread, I use the orange line, okay, which is on the bottom part. You can see we are buying the 270 call and selling the 280 call. In this case, notice it's not a call and a put. It's a call and a call. So it's a bull call spread. And the second case has no stock. It's only option. And notice how the orange line is almost the same as the blue line. So the risk profile is very similar. It's limited risk and limited reward. Again, instead of spending more time on this slide here, I'm going to just do this real time so you will understand this much better, okay? Before I do it, I said I had a bonus for you. You guys are very, very quiet today, by the way. So please give me some confirmation on the chat box that everything is fine. That would be very appreciated. Again, really, really, really appreciated. It takes nothing to type okay, so please do that. And in the meantime, on the screen, you have a QR code that you could scan. This will bring you to our website. And then together with that link, you have this coupon code called claim number 8, claim 8 with a number, claim 8. And with that, you can get auto climate for TradingView for free forever. And as you know, TradingView can be linked to Tiger Brokers. So now you can do your market analysis on TradingView using AutoClimate, which I'm going to use in a moment to analyze the markets. This tool is extremely powerful. It's all about statistics to tell you if you should be a buyer or a seller, and if you have odds in your favor or not by doing so. And again, good news, it's free and you can use it with TradingView connected to Tiger Brokers. Okay, so use that coupon code Claimate, use that QR code tradewithufos.com/aclimate, and then you can get it for yourself. I'll take a sip of water and we go for real-time charts in the latest portion of our session today, where we look at an application of a collar and we look at the market analysis, the SMARTT market analysis. Here we go. So let's go for it. I'm going to stop sharing the PowerPoint. So my video stream, meaning me and my face, will go away too. And what you're about to see in just a moment, it's going to be a trading platform. Just one moment. I am just making sure I am sharing the right screen with you guys. Here we go. And now you are about to see my trading platform, which is top. Okay, this is top. Cool. So what do we have here? Well, I have a chart with a JP Morgan. Okay, and let's go back in time and let's pretend. Okay, so that way, you know, I make this example a bit more like what it looked like in real life. Okay, so let's say a few days ago, that was beginning of November, you look at the market. Let's say you're a technical trader. Let's say you look at this high as a key support area or resistance, I should say, and price went through. So this is a potential breakout of this high. And let's say you're a breakout trader and you want to get in. But of course, many breakouts become fake outs. So you're like, look, I'm not going to get in unless I have a UFO that supports my trade. And here's the UFO. So you're like, okay, that's it. So I just need price to come back inside the UFO. I'm going to buy here. And then I expect price to go. Okay, so let's say you did that. Okay, and the next day price came in, so you bought. The next day it went a bit against you, and then it kept going, and then it kept going. Okay, and now it's going even more. Okay, and now you're in this trade, and you know you enter down here at 125 or something like that, and now it's trading at 135. So you're making around $10 on this trade per share, and you are happy, but you are realistic. Meaning that, hey, look, it's looking like I'm going to get to this target. That's the red UFO. The expectation is when price gets there, unfilled orders to sell will kick in and the market will fall. So when it gets there, of course, you want to sell and collect your profit. But look, the S&P, which I have on the left, has been rallying and rallying and rallying for a long time. So maybe you have a concern, which is, hey, what if the S&P corrects? Okay, and what if beyond a correction, something happened again in Ukraine. I mean, sorry to mention Ukraine so many times, but just because I mentioned it before. And what if this market just like crashes, and needs to go back all the way down to those 118 UFOs before it goes back up, right? So now you're gonna be in pain because you enter this trade around 125. If it drops to all the way to 118, now you're gonna be in a net loss. So maybe at this moment in time, you are like, you know what? I'm kind of equal distance between the red UFO and the green UFO. This is a very good time for me to do a collar and neutralize, in a way, the risk of this trade. So how can you do that? How can you do that? You will load an option chain, and of course, you can do that with the Tiger Brokers app. You don't need to do it with Top, even though, of course, Top is the platform I use, and therefore I'm going to do it with Top. And so let's say you're looking at January expiration options, for example. You're going to give this trade the opportunity to go through the potential Santa Claus rally. Okay, and this may happen or may not happen, but there is a statistic there that suggests that around Santa Claus the markets may rally. So you may want to give the opportunity for the stock to go your way. You don't want to cut it using December 16 expiration, and instead I went for January 20 just to give myself extra time. Okay, now if I do that, what is the red UFO? 140, right? So what if I sell the 140 call. Well, the 140 call is supposed to pay me 345. Okay, so if I sell the 140 call that expires in January 20, I am going to collect $3.45. So which put can I buy that would cost me that amount more or less? Well, notice how the 130 put is trading around 380. So if I was to add this one to the mix, notice how the net cost of the collar would be 35 cents. So I would get paid 345. I would have to pay 380, and therefore my net cost would be 35 cents. Again, I'm shooting for free. Again, free is an ideal situation, which often will not happen. So in this case, this would be the best it would get. Okay, 35 cents. So so now, what if, again, let me simulate this and you will understand. So what if I add my stock, and again, let's say I purchased my stock when it was trading around 125, based on what we said before. So this would be the net result of the trade I would have. That would be the graph, okay? So now, what happens with this trade? Worst case, I cannot lose money. Notice that in the worst case, I am gonna make $400+. My maximum risk is a negative risk. By coloring the stock at this moment in time, assuming I purchased the stock at 125, I will now end up in a position where I cannot lose. And if the market rallies and reaches my target, I could make up to 1,465, which is up here, assuming I reach my target at 140, which is where the red UFO was on the chart. So notice how beautiful that is, right? So now, worst case, you're gonna make 400+, you're gonna lose, even if the stock goes to zero. This is not a stop order, guys. Even if the stock goes to zero, I mean, let's face it, it's quite unlikely for JP Morgan to go to zero, but even if the stock was to go to zero, you are protected because you own the 130 put. Just in case, okay, this is not clear enough, let me go ahead and use a simulation here with a projection, and notice how no matter what, we are having a positive outcome. If the stock drops, okay, of course, we are making less, okay, but even if the stock drops all the way to zero, all the way on the expiration date, notice that my $465 is something that no one can take away from me. Of course, if the stock is not going down and on expiration is reaching, let's say my target at 140, 141, so now I'm going to make my 1,400+, okay? So, and this is, by the way, no matter what happens to implied volatilities, implied volatility drops, implied volatility rallies, this will have an impact during the life of the trade, but on expiration, it doesn't matter. Worst case, I will make 465. Best case, I will make 1,465. Okay, so that's a collar, and it's a powerful strategy that makes it more efficient to protect your stock versus just buying a put, because buying a put, it's very expensive. Great. So now that we know what's a collar, it's time to do our SMARTT market analysis. And again, as always, I would like one more time to request in the chat box that you guys come back to me with a confirmation on the chat box that all is good. I have seen extremely little interaction from you guys. I don't know why is that. Maybe my app is not working fine. So just in case, I am reloading the app just in case. Okay, but I'm doing all of these, guys, because I need your interaction. This is, again, super, super important for me to see your comments so I can guide you. I mean, you can see this is powerful stuff, right? So if you have questions, do not hesitate to ask so you can implement that in your own accounts, okay? Cool. So I'll check out your comments in a moment, and let's begin with the SMARTT market analysis, okay? Special market analysis for tiger traders. So let's begin. On the left, I got the S&P ETF. In the middle, I got S&P futures in a 34-minute time frame, which is intraday trading, okay? Why am I looking at futures intraday before I even start? Well, to find out what's going on so far. And so far, the futures is trading 0.12% up compared to the yesterday close, which means that the S&P ETF, and therefore the majority of stocks in the market today, will have a tiny gap up, okay? So the market is likely going to open just a little bit up, a little bit down, a bit in the boring side, if you wish, okay? Nothing wrong with boring. But that's what futures are basically telling us. Now, futures are also telling us that if that market was to fall, and let's say we have an open and the market starts falling down fast, we're gonna hit those UFOs, and we should see a rebound very quick as well. Okay. Now, this bounce to the downside is located all the way at 399. Okay, if we look at 399 on the S&P ETF, notice how now I am looking at SPY 34 minutes. Is not futures anymore, is the S&P ETF. Notice how at 398.74, which is more or less 399, notice how I also have green UFOs. So in other words, if the market opens, gaps down or gaps up, starts moving and then crashes fast, we're going to have a very fast move to the upside. Okay, and when I say we are going to have, I'm talking about statistically speaking. Of course, I cannot guarantee, I don't have a crystal ball, but certainly this is likely to happen, okay, based on the UFOs. Now, with that setup in place, and with that thought in mind, let's look at the S&P ETF in a daily time frame, okay? Not in an intraday time frame, but in a daily time frame. So what do we see? Well, we see the auto climate, okay, which, by the way, this is the tool I told you that you guys can use for free. Okay, so again, in case I did that too fast or you're joining the session late, let me put it here. So here's your link, here's your QR code, here's your coupon code CLAIM8 for you to go and get auto climate for free for TradingView, that you can then connect to Tiger Brokers and do your trades and do your analysis of all stocks, all ETFs, including futures, by the way, in TradingView. So you can get all of that there, okay? So now coming back here, so on the daily time frame, the climate suggests that we are in a blue climate, which is confirmed. In other words, being a buyer carries with it a statistical advantage. And not only the climate says that, I just said the UFOs too. So in other words, if the market opens and goes up, we may see new UFOs, and trading to the long side would be the way to go based on the climate. But if the market goes down, just wait until the market comes to those green UFOs, and from there, we should see the market go back up. That's the market setup that is, the market is presenting to us. Again, all of this is based on stats and based on market data. This is not financial advice, as I said at the beginning of the presentation, but that's market data, okay? So this is how I think of markets from a statistical point of view. So now, note of caution, careful, careful, careful. Statistically speaking, when the climate becomes blue like it is now, statistically speaking, those waves should last by 5 candles at a time, and the current wave has been running for 8. In other words, we may be falling into overextended and therefore unsustainable. Okay, but I'm not too concerned because we got green UFOs. So if the market goes down, it may go back up. Now, the moment those unfilled orders get filled and the market goes up, because when price comes here, the unfilled orders will get filled. That's how the market goes up. So the moment the unfilled orders gets filled, the technology will basically detect that, and those UFOs will be deleted from the screen. So if that's the case, notice where the next UFO is, all the way at 375, which is all the way down here. So we may have a pretty deep correction in the market before the market resumes and go back higher. Okay, this is what we can see. But for that, those UFOs first need to be cleared. So I would expect today in the intraday session, markets to either go up, or if they go down, to go back up. But the moment those UFOs go away, and therefore that could be for tomorrow when they are not there anymore, then I would expect the market to change from a blue climate back to a red climate, have a dip, and then go back up the moment we get back to those lower UFOs. Okay, so careful. I would suggest from this analysis that the right actions, if you have portfolios, is actually to start coloring. Why? Because there is a possibility for the market to rally a bit more, but there is also a possibility for the markets to go deep to the downside. And having colors, as you saw, could be a very nice way to add protection to your portfolios. Entering new long positions, I would not be a fan, because again, 8 out of 5, it means that sooner than later, the market will tend to correct. Now, when I say correct, I mean something like that, to then go back up. Why am I suggesting that the markets are, potentially going to go back up if they're correct? Because look at what's happening here. And this is where the SMARTT portion of the analysis comes into play. Okay? SMARTT with double T, right? So this is options data, my friends. We are comparing the implied volatility of the calls compared to the implied volatility of the puts. The calls are blue, the puts are gray. Who is above? The blue line is above the gray line. In other words, in the options markets, I'm not even talking about the chart, I'm talking about the options markets, right? So I'm talking about this kind of thing. Okay, this is options data, okay, which is difficult to see here, but very easy to see those lines. So what is that options data suggesting? It is suggesting that we got buyers in the options arena. We got buyers in the options arena. So now the options arena means many different strikes, right? So of course, I mean, you could start looking at the strikes and notice how here, we got 15,000 calls versus 12,000 puts, 11,000 calls versus 6,000 puts. So you can see how we got more calls than puts in many places. Not all strikes are going to be the same, but we got many cases where we got more buyers than sellers in the options market. So in other words, if the market falls and corrects very, very quickly, we are supposed to hit those buyers. And the moment we hit those buyers, the market is supposed or likely to go back up, which would make a lot of sense. Statistics suggest a down climate to last for 3 days and then go back up. Okay, like it happened here. Okay, so I would say pretty healthy market environment. If you are trading stocks to the long side, pretty healthy market environment. Just be careful with the lack of volatility this week because of Thanksgiving, the potential peak of volatility into next week, and if something crazy happens, especially, again, Ukraine, the dollar index, etc. So we gotta watch. That's why we're talking about colors, because it's a great way to protect your portfolios in a day like today, where the market, reaching 8 out of 5 may correct soon. And if that is not a correction, and I happen to be wrong, and the market just go down severely, those collars would protect you, lock on profits, okay, and don't have your portfolios to hurt you in a way that is, too aggressive. So anyway, that's all for today, my friends. Hopefully the session today was insightful, was useful, was fun. And I have to say, guys, that you have been very, 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 very quiet. And I know that, it may be more comfortable to be sitting in the sofa and just listening. But, I have to say, if you don't mind me to say, I'm just a bit straightforward at times. And if you don't mind, I will be now. I'm asking for permission to be a bit candid, with all respect. But for sure, you didn't make it too easy for me, guys, just being very, very quiet. Okay, so next time, I'm counting on you guys to be a bit more active with me on the chat boxes, because basically, I just presented what I thought was good for you guys, but having your feedback would certainly make the sessions to be much better for you guys. And I only see you once a month, twice a month, sometimes 3 times a month, but most of the times it's 1 or twice. So I miss you guys, and I need your interaction next time. Okay, guys? So keep that in mind, and I will see you then. Take care, trade safe, be safe, trade well. Bye-bye. And of course, Tiger Brokers, thank you so much for putting the environment, the ecosystem, the meeting room, the webinar room. Thank you for putting all of these tools for the community available to us as well, to be able to participate of these sessions and to help everyone, and also have a little bit of fun on my end, because I really love this. Okay, so you guys take care. See you soon. Bye everybody.